You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everyone. We've transitioned into the seasonally weak period of time for the stock market, which are the months between May 1st and Halloween, and we're going to take a look at how much different stock performance has been historically during this time period, and then I'm going to touch on what's been going on in the stock market in the short term, look at a couple individual stocks, actually a few stocks, how they've been behaving. And then we'll close out today with some signs I've been looking for as we move into the months ahead. But first, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness. And that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So please come back often. If you're a listener, somebody who wants to listen on walks, in the car, on the treadmill, then feel free to check us out on iTunes. If you're somebody who would rather watch and listen, then check us out on YouTube and be sure to subscribe on both. In addition, you can also follow me on Twitter at Adam Koos and on Instagram at Financial Surgeon. And then last but not least, all links, visuals, charts, and other educational resources are always available on our website. And we are going to have some charts and tables today, even though for those of you on iTunes, I am going to talk you through them as best as I can. So let's go ahead and get started today and jump right into it. The quote of the day here is from Yale Hirsch, who originally started the Stock Traders Almanac, and it goes like this: sell in May and go away. And that's what we're talking about when we talk about the seasonally weak months of the year for the stock market. Again, it's the months between May 1st, that is, so May 1st, and then the end of October or Halloween. And when you go back in time, the performance has been starkly different when you compare the seasonally good months of the year, meaning November 1st until April 30th, when you compare them to May 1st through October 31st or Halloween. And here's what the data looks like in a picture. For those of you listening on iTunes, what we're looking at here is, generally speaking, when you go all the way back to 1950, so we're talking about 71 years here, the stock market during the seasonally weak months of the year, so between May and October, has not really gone up all that much. We're talking about an absolute huge dislocation between the seasonally good months and the seasonally bad months. And some of you might think, well, why in the world would I ever invest at all during the seasonally weak months of the year? And it would be a good question. And the answer is, I always tell the joke about the guy who drowned in a river that was an average of 4 feet deep. And that's the joke. That's it. I mean, averages are just that. They're averages. So just because seasonally speaking, over a 71-year period, the performance of the stock market has not been good during these seasonally weak months doesn't mean we should just completely avoid the market, especially when you consider the fact that things are changing all the time. The market's changing all the time. You know, back in the 50s, we're going through an industrial revolution. Obviously, I think we're going through more of a technological and service revolution, especially when you look at the work from home world that we live in now versus before, and technology and all the things that have changed these days. So that's one of the first things that we have to consider, though, as we move into the summer months, is the fact that the market does tend to, on average, not perform as well. Does that mean it's not going to perform well? No, it doesn't. It just means that the average performance is weak. I believe, don't quote me on this, I believe that the number is the average performance of the stock market since 1950 during the seasonally weak months between May 1st and October 31st, I believe, is 1.7% annualized. I believe that's the number. So, again, not the best number in the world. Now, another thing that I tweeted out this past week was looking at a really, really slow long-term chart here. This is a monthly chart. Every little tick you see, every candlestick that you see on this chart, and for those of you listening on iTunes, this is a chart going all the way back to 1994. Obviously, we have the dot-com bubble in here, the 24-month, 47% crash. Then we have the good months that come from 2003 March until October, when the market peaked in 2007, and then the market subsequently dropped 57% over the next 18 months, a very long period of time, and a very deep recession, a deep bear market. And then we have kind of what's happened since then, and we're what I was paying attention to here on this chart was times when the market, in this case the S&P 500 or the SPY, the ETF that tracks the S&P 500, the times when the S&P has been more than 15% or more above its 10-month moving average, or in other words, 15% or more above its 10-month trend. And what that would generally mean to me is that it would be very overbought. In other words, it would be very frothy, very toppy, very kind of long in the tooth. And when I looked back all the way to 1994, what I found was that generally speaking, and there's only been 5 times, by the way, since 1994, when we've been 15% or more above the 10-month moving average, and I marked all 5 times in arrows. The first time was back in 1998, before we had kind of a pullback. Not 1998. This is 1997. And then we had 2 periods of time where it was up above 15% above the 10-month moving average, but it was coming off the bottom, which is kind of like what we're seeing right now with the Corona crash, coming off the bottom of the market. And then we have just this year, we have 2 times now where we've seen the market up more than 15% above its 10-month moving average, and one of them was last month, so the month of April, and the other one was the first month of the year. So when we see this daylight, and when I talk about daylight, I can't remember who originally coined the phrase, but it's the distance between a moving average, in other words, this blue shaded area. So for those of you listening, the 10-month moving average, the more distance you get between that moving average and price, wherever the market's at, it creates more white space, which I like to call daylight. And the more white space you get, the higher the probability of either A, a market correction or pullback, or B, a sideways consolidation. Now, if you look back in time, you go back to 1997, what we saw when this happened was kind of a sideways choppy market. And I know it's kind of hard to tell for those of you that are watching, but for those of you listening, when we've seen this happen, a sideways consolidation, when we're looking at a monthly chart, can look like nothing, because we're talking about 1, 2, 3, 4, 5, 6 months, 7 months, which is 126 plus trading days. That's a long time. It's a lot of weeks, obviously. 26, 30 weeks or so of sideways choppiness, up, down, up, down, up, down. And then fast forward to 2009, 2010, you had the same kind of thing. They got this daylight, this extended nature of the market being a little bit high and overbought. That doesn't mean it can't continue to go up, doesn't mean it can't continue to be overbought. But generally speaking, what you saw after this was in 2010, this kind of pullback or this market correction that we saw in 2010 that occurred shortly thereafter. And then what we're seeing now, again, off the coronavirus bottom last year, is now we're seeing these 2 time periods where the market's kind of creating, again, this big space, this daylight between the 10-month moving average and price today. So that's one of the things I'm kind of looking at as a not a sign of caution. Long term, it's good. I mean, without a doubt, unequivocally, the trend here is up, not down. So I'm not being bearish. I'm not being a doom and gloomer. I'm just saying that it would not surprise me in the least bit to see, if not to expect, in fact, that's kind of what I'm saying here, is that I expect the market to either pull back to the tune of, say, 4 to 6% or so in the next, couple months, or maybe even to see a sideways choppiness. So kind of where that moving average, that trend catches up with price and squeezes that daylight out and gets closer and closer to the moving average. And that can happen either by having a correction, whether that's a 4 to 6% pullback, could be a 10 to 14% correction, which is also normal, by the way. That happens on average about once a year. Or it can happen over time where it just kind of chops sideways, like I said, and it digests the gains we've seen, and then we could be off to the races again. So that's another thing I'm looking at. Get in some individual stocks here. One of the problems that I've been seeing underneath the surface of the market is things like this. We're looking at Amazon. When you look at the stock price of Amazon, and again, for those of you who are listening, the price of Amazon has been pretty much trading in the same place since July of last year. So it's May, right? So we're closing in on 1 year that Amazon has gone absolutely nowhere. And then what you see here on the right side of the chart is you see this upward movement. Obviously, there's a lot of choppiness here, but we see this upward movement out of the end of March through April up until earnings. And then the earnings announcement comes out, and they just blow away earnings. You can see here on the bottom of the chart, 215% earnings growth, 44% sales growth. and then their after-tax margin is the highest it's been in a year in terms of growth year over year, and then the stock just goes down. So you don't want to see that, I guess. In a healthy bull market, what you want to see is stocks maybe after earnings come out, they kind of sit tight. They stick around where they are because we expected earnings to be good. They were good, so either they sit tight or maybe even they head higher. You get a nice big surge in momentum and surge northward. But what we're seeing here is not that. We're seeing the price of stocks like Amazon leading up until earnings going up, and then all of a sudden we're seeing this kind of drop or like a pop and drop. The next one I'll show you here is Netflix. Similar story here. Netflix has been trading at the same place again, just like Amazon is trading at the same place it has been since last year. And you get this move up until earnings. You get 139% earnings growth, and then it gaps down. So when I say gaps down, what I mean is earnings comes out, and the next morning it opens down 7, 8, 9%. And you can't even sell it in order to stop out and protect your principal. It literally opens up lower than where it closed yesterday. So you're kind of stuck where you are. And as you can see if you're watching on YouTube, since then, since earnings came out for Netflix, it's pretty much been chopping sideways with a slightly downward bias. But we've got a declining 50-day moving average. That's not good, obviously. But again, we want to see when good earnings come out, big blowaway earnings. We want to see positive movement, or at the minimum, neutral movement out of these stocks. Here's another one, Tesla. Everybody loves Tesla, or at least Tesla owners love Tesla. Tesla stock owners love Tesla. So we've got, again, the same story here. Tesla obviously been struggling since pretty much January, since the beginning of the year this year. It's gone down from, peaked at $900 a share, bottomed out at about just below $600 a share. But coming into earnings, again, we had this movement where we went from $591 a share on Tesla up to $780 a share, and then it kind of starts to chop sideways. Earnings comes out, 304% earnings growth, 74% sales growth, and it goes down. So again, I don't want to say it doesn't make sense, because it does. It doesn't matter whether it makes sense or not. What matters is how are stocks behaving and how are people reacting to, in other words, investors. How are investors that are clicking their button to buy or sell, how are they reacting to these earnings reports, good or bad? Are they taking the earnings and saying, this is great, I want to buy more, or I'm not going to do anything, or maybe there's a balance, a nice equilibrium of supply and demand? That would be good. But what we're seeing instead is not an equilibrium. We're seeing more selling than buying, and that downward selling enthusiasm is obviously causing these stocks to go down in value as people are apparently, or potentially, I should say, taking profits after great earnings as opposed to buying the stocks. I've got a couple more here for you. Twitter, I'll go faster through these because I think you get the point. Twitter has had a pretty good 12-month period, I'd say. But just recently, stock was kind of trading sideways right up until earnings. Earnings comes out, it beats earnings, 45% earnings growth, 28% sales growth, and a little bit, obviously, less after-tax margin down here. But bottom line, again, we get a gap down. We have, it's trading now here, 15%, it was the gap that it closed down just in one day. And then Uber Technologies. So Uber, everybody knows who Uber is. Uber had a rough go last year, obviously, due to coronavirus. Hadn't really gone anywhere in about a year. And then all of a sudden after October, the market started to discount this idea that the economy was going to reopen again, which we all know is obviously happening. It's going to happen. Things are going to get better. We're going to get back to some resemblance of the old normal, I think. But the stock pops up in November, and you kind of start to see this steady northward move in Uber up until, again, earnings comes out. And they're not like, stellar earnings or anything like that, but the economy is opening up. Things are getting better. Now, maybe not so much in India right now, obviously, but here in the United States, I believe the number is more than 1/3 of people are fully vaccinated. And there's people like, for me, for instance, I'm getting my second vaccination on Tuesday. So there's several people who got the Pfizer and Moderna vaccinations who haven't had their second yet. But at some point, that number's going to keep getting bigger and bigger, and I think we're going to get back to some sort of resemblance of the old normal. So to see Uber go down 24% in 16 days, not including today, this is of yesterday's close, isn't what you want to see in a positive, enthusiastic, behavioral psychology type of environment where investors that are clicking that buy or sell button are clicking the buy button. This is obviously the sell button that's getting clicked here. So all these charts I just showed you are kind of concerning me. Again, understanding that long term the trend is without a doubt still up. So maybe now would be a good time to share that when we look at the stock market, there's the major market indices. You got the S&P 500, and on this chart we're looking at here, the Russell 2000, which is a small cap index, and then the NASDAQ, which is a lot of technology companies. Generally speaking, the NASDAQ, the S&P, and the Russell tend to move together. You have this, they're not 100% correlated, but they're very correlated. You tend to see when one goes up, they all tend to go up. When one goes down, they all tend to go down. And instead, what we've seen just this past few months is this huge disconnect between the S&P 500, which has kind of continued to grind up, while the NASDAQ and the Russell have both just pretty much gone down since the beginning of February, to the point where there's a huge divergence between these two. And one of two things has to happen here. Either A, the S&P 500 is going to throw a rope down and pull up the NASDAQ and the Russell and pull them up so that they can get back into sync again and get back into correlation, or these smaller company stocks, technology stocks, which is there's a whole lot more of those than there are. The Russell and the NASDAQ are much bigger than the S&P 500. So are these smaller companies, these technology companies, going to pull down the S&P 500 with them? In other words, kind of going along with that theme of seasonally weak months of the year, seeing a lot of stocks that are popping and dropping on earnings, seeing underneath the surface that there's I don't have a chart for it, but breadth. So participation in the market on a short-term basis isn't what it's been this past, call it 6 to 9 months. It's been getting weaker. Long-term breadth, on the other hand, is wonderful, very bullish, which is why I keep saying the long-term trend is up. So I guess my feeling here is one of these two things has to happen. Either the NASDAQ and the Russell are going to catch up to the S&P, or the S&P is going to catch down to the Russell and the NASDAQ. And my feeling is that we should probably see the latter, because it's been a little while here. The S&P 500 has a tendency to touch its 50-day moving average roughly, every 2 or 3 months, and it hasn't done so in a while here. So it's been, I'm looking at it on another screen here, it hasn't touched its 50-day moving average since about mid to late March, and here we are in May. So again, it wouldn't surprise me, and it wouldn't be bad either, by the way, to see a 4-6% pullback, or even a correction again, a 10%, 14% correction sometime in the next couple months, just to see things get digested, get things reset, and then send us back off into a new healthy short and intermediate term uptrend. Now, speaking of this divergence, this is from Sentiment Trader. Sentiment Trader is a website. They do research, tons of wonderful research, and the chart that I was just showing you that showed the divergence. So for those of you listening on iTunes, that divergence where the S&P 500 has continued going up for the most part, while the NASDAQ and Russell have been going down. The statistic here, which I thought very interesting, was that we have signal dates on a chart, and if you can come back, if you're listening, and check this out later on the web or go to the YouTube link, either way, it doesn't make a difference. But to see this chart, I find it super interesting. So there's only been 1, 2, 3, 4, 5, 6 times, including now, in the last since 1990, that we've seen more than 80% of the stocks on the S&P 500 above their 50-day moving average, above their 50-day trend, while the NASDAQ and Russell stocks, more than 50% of them, are below their 50-day moving average. So you just don't see that a lot. Again, like I said, these different major market indices have a tendency to move together. And while we've seen a lot of sector rotation, in other words, we've seen a lot of the technology stocks getting beaten up. You got Cathie Wood's ARK funds getting beaten up. A lot of the big names that did really well last year, like the work from home stocks, those have been beaten up really, really bad. And we're seeing this rotation into value, things like financials, energy, which to some might not make sense, but I think it makes perfect sense. And it's also a good thing when we see rotation in the market. We don't want to see just one or two sectors leading the whole market. We want to see rotation, but it has been a really, really choppy year so far. And again, with the S&P and the stocks in the S&P being so high relative to all these other stocks on the Russell 2000, 2000 stocks, and the NASDAQ, which is a very big index, you see these time periods where the market has a tendency to either A, go into some sort of decline, or it tends to chop sideways before heading higher. So I thought that was a really interesting statistic. Now, the last chart I want to show you today is one of my best friends in the business, and a very, very good friend in period. One of my best friends is Andrew Thrasher. We talk all the time. He shares all kinds of great research with me. We powwow on the markets all the time. And this is something that he built as part of his award-winning Charles Dow paper a few years ago through the certified, now it was going to say Market Technicians Association. Now it's the Chartered Market Technicians Association. So through the CMTA, he won an award for what he calls the volatility risk trigger, or the VRT for short. And he's produced a second version of this, and this is what I'm showing you here. And what I love about this indicator is, while it's extremely heady, so you have to stay with me here, it is, I don't want to say extremely accurate and say it's unbelievably predictive, or give this idea that it has some sort of guarantee of what's going to come in the future, but it's a very accurate indicator of volatility and what we might expect going forward. So here's what you're looking at. So if you're on iTunes, head back to the website, go to the education tab, drop down there to podcast, click on this podcast. You'll see the images that we're going to post, and you'll see this VRT. And what you're looking at here is it's a proprietary signal. Andrew obviously built this. I don't know what's in it. I know some of the things that are in it, but not all the things, and it doesn't really matter if I started rattling off different pieces of what he's looking at. But we're looking at volatility. The VIX obviously measures volatility. So for those of you who are novices, when the market goes down, the market participants' fear have a tendency to go up. So people get fearful when the market goes down, right? Well, volatility is measured by the VIX, and when volatility goes up, the VIX goes up. So pretty simple. And what you tend to see is when the VIX goes up, the market's going down. That's as simple as I can make it. So when you see these little arrows here on the bottom, every time the volatility risk trigger, or the VRT, has signaled, what you tend to see is a low in volatility and a spike thereafter at some point in the next few weeks. Again, it doesn't, like I said earlier, it's not a perfect indicator. There are times like here in 2018 where it signaled volatility actually went down before it went up. Then it came back down again, went back up, but kind of chopped sideways. Then there was a second signal before a couple weeks later, then volatility really spiked into the fourth quarter of 2018, which for those of you, if you don't remember, the market went down about 20% in 59 days. And this was after the VRT triggered that this volatility indication was going to go up. So in other words, volatility trigger goes off, market starts to go down sometime within the next few weeks thereafter. And we can go back in time, but what I really want to focus on is since 2020, there have only been 3 signals. The first signal was in January, about a few weeks, call it 4 or 5 weeks, 6 weeks before the initial volatility pop, which then came back. And then we saw, of course, things go crazy with the coronavirus. But again, this thing signaled, the VRT signaled the first pop in volatility before it pulled back, and then the market really went gangbusters to the south side. It signaled again in 2020 before the September drop and the correction we saw in September and October. And then we just saw the volatility risk trigger again this past week. I believe it was Tuesday. So now we have a risk-off signal, I'll call it, where the probabilities, not certainties, but the probability of the VIX spiking and a potential market pullback or correction in the next few weeks is higher than average. I would say much higher than average. So that's what you're looking at here. I think it's a really, really interesting signal. And if you have any questions about it, let me know, and I'd be happy to kind of pass them on to Andrew and get them back to you. So to the bottom line, obviously we want to focus on price, trend, momentum, volume. We want to focus on what's going on in the market, and not focus on what's going on in the news. The news is there to confuse you, entertain you, and keep you watching the news. So, pay attention to your financial plan. Pay attention to how much you're saving. Even though we're in the seasonally weak months of the year for the market, try to max out your 401k plan. If you're maxing out your 401k plan, try to max out your Roth IRAs if you're eligible. If you've already done that too, then you are easily in the top 5% of savers in the world, and you're a rock star. So now we need to talk about whether or not we need to look at things like brokerage accounts, TOD accounts for savings, and things like that. So anyway, bottom line is the long-term trend, I can't emphasize more, is decisively up. So the long-term trend is up, which means that if we get a pullback in the market or a correction of some sort, which would obviously be worse than a pullback, it would be healthy. I want to reiterate that. And it would be buyable. I think that a pullback or a correction in this market right now, in my opinion, would be buyable for the reasons that the Federal Reserve is on our side, even though I don't agree with the fact that they're buying, billions of bonds, triple B and higher rated bonds per month. They're buying a lot of bonds, and that money's got to go somewhere. A lot of stimulus packages. The one that went out for tax season's done. We've got another infrastructure stimulus package that's coming out. I'm hearing that it's probably going to get passed in September. I have no clue. But obviously that money has to go somewhere. Infrastructure, they're talking building, construction, roads, bridges, and so on. That's all good. Not for the whole market, but for some of the market, right? And that's where we want to take advantage of those sectors doing well and the companies in those sectors doing well. If that's where the money's going to go and it's being, artificially created, it's still being paid to those companies, which is going to help their profits and help their stock prices. Long-term breadth, like I mentioned earlier, is participation. So the long-term participation in the market, what we want to see is lots of stocks going up and making the market go up, not like 5 stocks going up, making the market go up with the rest of them kind of chilling out or just going down. We want to see all the stocks going up, not literally all of them, but we want to see, well, I guess that wouldn't be bad either. We want to see most stocks participating in the uptrend, and that's what we're seeing right now. So things look good in the long term, but the short term looks very toppy, looks a little suspect, sketchy, which is why I think that caution is warranted right now for the short term, and that we should expect a pullback in the market. And if it doesn't happen, great, but I think we should expect one. Moving into the seasonally poor months of the year, of course, for the S&P 500 and the Dow, that's something to keep in mind. Again, individual stocks underneath the surface that should be going up or at least staying flat after great blowout earnings are not going up and staying flat. A lot of them are squatting and then declining, which doesn't make sense in a bullish market that's very, very healthy. Which again, I'm only talking short term here. I think long term the market still looks healthy. And then lastly, again, we're talking lots of rotation out of the work from home stocks. We're seeing a rotation into the economy stocks. And then we didn't talk about bonds today. I kind of forgot about bringing that up. But even long-term bonds, 20-year treasuries, 25-year zero coupon bonds, which I've sent out a few letters or videos to clients. I think it was actually our monthly market brief that we sent out. It's a private clients only newsletter that we send out every first of the month. We've been talking about this bond trade and how bonds have been going down, call it 22% on the 20-year treasury since August of last year. And most people think, man, I thought bonds were safe. And it's like, well, yeah, bonds are generally safe because they're bonds and they pay interest, but we're in a different environment now where interest rates have been going down for 30, 35 years, and now we're starting to see a bottoming process occur in interest rates, and it's just that. It's a process. It's not like a stock market bottom where you see this big flush of sellers come in and then buyers come in and take over. Interest rates take much longer to bottom than stock markets do during a crash. So I think we could even see lower rates again. I think is entirely possible. And right now, while bonds looked really, really bad between August and we'll call it, mid-May or so, early May, they actually don't look so bad right now, and there's a potential reversal in trend occurring. So that's on treasuries, that, by the way, just to be specific. There's other bonds out there like treasury inflation-protected securities, high-yield securities, convertible bonds. A lot of those still looking very good as well. So I'm going to go ahead and close out for the day. I think I went off the reservation a few times here and, rattled off on some tangents. So why don't I just close out? Thank you so much for watching today's show, for listening. Feel free to share this episode to your friends and family if you'd like to discuss your personal situation further. Always remember that you never have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website at libertaswealth.com to schedule something in our calendar. As I always say, there's thousands of podcasts out there, obviously, and you chose to give ours a listen or a watch today, so thank you so much for tuning in. Be sure to subscribe on both iTunes and YouTube, and remember, you can sign up at libertaswealth.com to not only get these videos like the podcast, but other videos, screencasts, articles, and market commentary, what we call Coach's Corner educational articles on financial planning, retirement planning, estate planning, delivered directly to your email inbox whenever they come out. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.